Hello everyone, I hope you guys are doing well and your studies in the last lap are going in full swing. Now in today's video, we are going to discuss and share the solution for one very important problem, which is the September 25 consolidation question. A lot of you have had a lot of doubts and I had received a lot of messages for this particular question. So I'm going to share the PDF simplified handwritten solution for this particular question in a relatively simplified format with a lot of reference notes as well, as you can see on the Telegram channel, the link for which is in the description, as well as quickly discuss the entire question so that in case something like this comes, you know what is to be done. So over here, if I review this question, at least from the perspective of what the institute has done and what you should be doing in the exam. So there is a company R which is a subsidiary of Z. The balance sheets are given to you. Well, by the way, these are given in lakhs. You have this standardized balance sheet and then there are a few items. Important over here is within share capital you have been given preference shares, so this is an important adjustment. And then within trade payables you have bills payable, within trade receivables you have bills receivable, that is fine. Within intangibles there is goodwill. Now goodwill usually does not appear in the standalone balance sheet, but it is given over here, so it may be appearing probably because you might have done some amalgamation, and because of that in the SFS as well there may be some goodwill. Now if you look at the additional information, there are a few additional informations. I would request you to read this question. We'll discuss the adjustments and the impact, but you can kind of read this question. So there is Z acquiring 12 lakh equity shares of R on 1st of April 24. This is 12 lakh out of the 300 lakh shares, that is 30 lakh shares. So 12 lakh out of 30 lakhs will come to 40% stake on 1st April and a further 13 lakh 50,000 shares on 1st of January 15. So this is 13 lakh 50 divided by, let us say, 30, which comes to around 45% stake. So I will actually acquire control on 1st of January 2025 when the control is, when 103 will apply, at the cost of 144 and 155.25 lakhs respectively. Now both of these are sitting within the general investment. So within this investment of 375 sits 144 as well as 155.25. Okay. Second is another important adjustment. So the preference shares of R includes preference shares with nominal value of 22.5 acquired on 1st April 24 at a cost of 54 lakhs. So this adjustment the institute has done in a particular way, and will tell you what is to be done because this is the only question which is a reference base for preference shares. Now apart from, so there is an adjustment pertaining to preference shares over here. The retained earnings had a credit balance of 45 on 1st April 2024 and the general reserve as on that date was 30 lakhs. This is on the start of the year. Remember, your acquisition date is 1st of January. Now R paid a dividend of 12% on its paid up share capital out of its retained earnings balance on 1st April 24. So this is paid out of the balance on 1st April 24. So this is paid out of the pre-acquisition profits for the year 23-24. The entire dividend received by Z in August 24. See, in August 24 I had only a 40% stake. I acquired a total of 85% stake on 1st of January. So this is a dividend that has been received before the date of acquisition. Remember, if the dividend is received before the date of acquisition, that is an income on investment, should go to the P&L, must be in the P&L. Again, when I calculate goodwill, I need the net worth balance as on the date of acquisition. This is again before the date of acquisition. So this would have reduced the net worth as on the acquisition date. No further adjustment is needed. Remember, if there is a pre-acquisition dividend, we typically pass an adjusting entry provided we have received the dividend after the acquisition date from the pre-acquisition profits. Here it is received from the pre-acquisition profits, but it is received before the acquisition date, and hence there will be no separate adjusting entry needed over here. On 1st October 24, the machinery was overvalued by 15 lakhs for which necessary adjustments are to be done. This is on 1st October 24. This is a little weird. The company charges depreciation at 10% on WDV basis. Okay, so this is regarding the PP value, but usually I would be given PP value on 1st of January. Here it is given on 1st of October. Bills receivable of Z were drawn upon R, for which bills amounting to 3 lakhs have been discounted with the bank, which means for these 3 lakhs there will be no intercompany elimination because this is discounted with the bank. So over here R has a liability to pay to the bank. It may be bills receivable for Z, however, because it is discounted with the bank, R over here, institute has ignored the application of 109. They've said that, well, if the bills is discounted, then I have a liability to pay to the bank, and hence that will appear as a liability. You're required to prepare CFS without rounding off. Okay, so in our solution also we have given the full numbers. for Z and its subsidiary on 31st March 25. This is the date of consolidation, with the assumption that group has adopted fair value method to measure NCI, and the fair value of each equity share of R is 14 rupees per share as on the date of acquisition of control. So maybe this is on 1st of January 25. If this fair value is given, we will take that. Institute has given some alternative treatment as well, but we will stick to the 14, which is the main solution which they have solved. And also on 31st March 25, ignore taxation and preference dividend if any. So if I look at the solution, the first step I will do is I will prepare the schedule 3 format, which is a blank format. Then I'll prepare the notes to accounts. While I prepare the notes to accounts, I will ensure that I will write all these numbers and I'll write them without rounding off, because the question has told me so. So ideally I'll prepare this schedule 3 format, and over here I will prepare these notes to accounts. Within that I'll write down everything. Okay, so you can just kind of refer that once. And within intangibles there'll be goodwill, so I'll write down whatever is the goodwill, and then we'll see what is the adjustment. I'll write down the investments as it is, and then we'll see what is the adjustments. Within trade receivables you will have bills receivable, within trade payables you will have bills payable as well. Now the problem usually arises at the end where we have share capital. Now typically share capital will include the parent share capital. Now parent share capital is 720. Now please pay attention on this. This share capital includes 600 of equity and 120 of preference. Now ideally the accounting for the preference shares depends on whether it's a liability or equity. If it is actually a liability under Ind AS 109, this will appear as a part of non-current liabilities, financial liabilities. If it is equity, then it will appear as a separate line item within other equity. It will not be shown as a part of equity share capital for sure. However, what the institute has done over here, especially for preference shares, is they have not done this in the most appropriate manner, but this is the only question that you have for reference, and hence we kind of mentioned that we should do it the way institute has done. So institute says that, well, preference share capital, ideally as per accounting standards, it's owners. As per Ind AS, it may be owner, it may not be owner, but as per accounting standards, it is owners. So they have kind of taken that baggage and solved it accordingly. That is, when they take the share capital of the parent, they take 600 of equity shares, that is 60 lakh shares of rupees 10 each, no problem in that. And they will also take the 12 lakh equity shares of rupees 10 each, fully paid. Even that is taken as a part of your preference shares. So in a way, they are treating preference shares similar to that of owners, not because it is classified as equity, liability. Well, probably the examiner over here has taken the AS treatment and continued it, and hence if it comes in the exam again, this is what you have to do. So as you can see, for share capital we will say equity shares, that is fine, but we will also have these preference shares of 120 lakhs. Okay, we have given a note. Ideally as per 109, if preference shares are classified as equity, we show them in other equity. If they are classified as FL, that is financial liabilities, we show them in non-current liabilities. IC has shown it along with equity share capital, which seems to be as per accounting standards and not as per Ind AS. To keep it consistent, we will also solve it in the same way in the exam for consolidation questions. We have seen multiple questions which are pertaining to debentures, etc., but we have not seen enough questions for preference shares. So, well, from an exam perspective, that is what we will stick to. At least when I have to show preference shares in a consolidation question, not in a typical Ind AS 109 or other questions. In a consolidation question, I'll show the preference shares along with my share capital. Perfect. Now I prepare my 3 working notes. Here NCI is at fair value, and hence the goodwill working will be full goodwill, and NCI initially will be started at fair value. So I will first start my working note 1, where I will start with standalone Z, where I will take the respective reserves 120 and 195. Then I will start with investments. Now when I look at investments, now ideally my existing investment of 12 lakh, which is at 1 crore 44, this must be at cost. Now I need to remeasure it at fair value, and hence there will be a possible fair value gain. So I will take 12 lakhs into the market price is 14. So if I do 12 into 14, this is 168, and 168 minus 44 if I do, I will probably get 28. Now for 28, I will pass the entry investment account debit. I'll increase the investment by 144 plus 28 to, let us say, gain on remeasurement, and this will go in the profit and loss account. So you will have a gain on remeasurement of 24 lakhs, and your investment will be remeasured, existing investment, at the fair value. Now there is also another investment which was done of 45% at 1st January 25, which is 155.25, and as a result, for your total 85%, I will take 323.25. Perfect. This is for the total 85%. Now this is pure equity. The problem also comes over here about preference. Will I take preference share investment in this calculation? Well, if preference shares are classified as equity, and if let us say you were to consider, then you can. However, the institute has not, and hence we will also not do that. In any case, the preference shares were acquired on 1st of January 2024 and not exactly on the acquisition date. But nevertheless, if it was classified as equity, we could have taken it. Though institute has taken a slightly different approach over here. They have not taken the investment in preference shares as a part of PC. Well, honestly, if preference shares are classified as a liability, then investment in preference shares should not be considered to be payment for acquiring owners. Okay. However, if preference shares were classified as equity, fundamentally they should be. Institute has done that. The answer is no. So what has the institute done? Before we proceed further, when you look at this adjustment, preference share capital of R includes nominal value of 2250 held by Z, acquired on 1st April 24 at a cost of 54 lakhs. So what they have done is, they have said that these are intercompany preference shares, so they need to be eliminated. However, they will not create a goodwill for something which is worth 22 lakh 50 of the subsidiary. The parent has ended up paying 54 lakhs, and as a result, there would be a difference of around what? Maybe 3150. Is that 3150 for acquisition of control index, or let's say the institute says no, this is for preference shares, and hence what they do is they debit the preference share capital by 22 lakh 50, credit the investments by 54 lakhs, and the difference of 31 lakh 50,000 will go into the consolidated profit and loss. The general thought that you might have as per 109 is that if these preference shares are classified as liabilities, then yes, the difference should go to the profit and loss. If it is classified as equity, then probably they might go into the goodwill workings. But from this question, it is amply clear that the institute, for a consolidation question at least, does not take it into the goodwill workings. They have not commented on whether they are taking it as a liability or they are taking it as an equity. The treatment is a little, I would say, arbitrary. But from an exam perspective, what do? Well, we will eliminate the intercompany preference shares. The difference we will take to the profit and loss account. So over here, when you pass this elimination entry for preference shares, it is preference share capital account debit 22 lakh 50 to investment preference shares 54 lakhs. Loss on elimination will be 31 lakh 50, which will go in the consolidated profit and loss account. Now, where will investment preference shares go? Well, they will be eliminated from the investments. Like from investments, your intercompany existing 40% stake, your 45% stake will be eliminated, as well as 54 lakhs are eliminated. Well, I've taken 144. One can always say that you take 144 plus 24 lakhs of gain, and then you remove entire 168. The effect is the same. So I will eliminate this. There is a loss on elimination of preference shares, which is 31 lakh 50. That's fine. And then in the preference share capital, the subsidiaries preference shares were how much? Well, the subsidiaries preference shares were actually, if I go to see where is this, 60. Now out of 60, 22.5 has been eliminated, and hence you are left with another, I believe, 37.5. Now ideally, where will this 37.5 appear? Now ideally, if these preference shares were classified as liabilities, which seems to be the treatment based on the fact that you have not taken this in goodwill workings, but if they were classified as a liability, then this 37.5 will appear as non-current liabilities, financial liabilities. However, with what institute has done with preference shares of the parent, they have shown this as a part of share capital, which means they have treated it as owners. But if they have treated it as owners, then this 37.5 represents owners in the subsidiary which is not acquired by the parent. So if these are owners of the subsidiary which are not acquired by the parent, like I have an 85% equity stake, so 15% stake equity which are owners of the selling company which are not acquired by the parent are shown in NCI. In a similar way, whatever is the remaining preference shares which are treated as owners of the subsidiary, which will be shown in NCI. So when I calculate NCI along with the equity, I will also take the preference. So sir, what do we do in the exam? This seems to be a little confusing. Yes, again I'm doing this and I'm telling you to do this the way institute has done, because this is the only question for preference share as a base. So I will say preference share capital of R 60 minus 22.5 is 37.5, which will come in NCI. Now the reference note is ideally preference share elimination should be based on financial liability or equity classification, but ICS ignored the same. and has eliminated preference share as above. As above meaning preference share capital 22.5 removed from that, and the remaining 37.5 kept in NCI. Loss on elimination going to the P&L, not impacting the goodwill working, and then investment being eliminated. So basically what is to be done as per ICI treatment in the exam, this is quite crucial. Loss and elimination should be taken to the consolidated P&L, no impact on goodwill workings. Remaining preference share capital of the subsidiary represents owners of the subsidiary, not taken over by the parent, and hence should be kept in the NCI only. Okay, so this kind of discusses what is to be done with preference shares. We have also tried to take these investments in equity shares, preference shares as well. When I look at NCI, well, out of the 30 lakh shares, 15% is held by the NCI and the market value is kept at 14 rupees. So this is 30 lakhs into 15% into 14, or I can say there were 30 lakh shares, out of which 12 was initially acquired by the parent, then another 13.5 is acquired, and hence there is still a remaining 4 lakh 50, if I am not wrong, which is not acquired, and each of these shares is worth 14 rupees. So the 63 lakhs will be the NCI, and because NCI is at fair value, the fair value of on the acquisition date of the equity NCI is around 63 lakhs. Now, because NCI is calculated at fair value, we take your investment, that is PC, plus the NCI, which is at fair value, minus net worth. Over here we cannot take any shortcut by taking only our share or 85% of net worth, because I am doing the investment for 85% stake plus NCI for 15% stake. I need to compare it with 100% of the net worth. So the working over here will be 100% of net worth. Now in this 100% of net worth, I will take what? Well, I will take the share capital of the subsidiary, that is 300. Further, I will also take the reserves. Will I take the preference shares over here? The answer is no. Why? Because preference shares were 60 lakh, out of which 22.5 have been eliminated, 37.5 is remaining, and that is kept as NCI owners of the subsidiary, which are not taken over by the parent. Remember, if investment in preference shares is not taken over at the top, I cannot show in the net worth preference share capital. If investment in preference shares was considered at the top, then the corresponding preference share capital could have been considered over here, though that is not to be done. So over here, that is regarding the net worth, and then we go into the analysis of the reserves. Now there are two reserves over here. There is the general reserve and there is the retained earnings. Initially we start in the usual way. We start with the balance on 1st April 24 and then the balance on 31st March 25. As the question tells you, it tells you that the retained earnings had 45 lakhs and general reserve was 30 lakhs. So you see GR of 30 lakhs, retained earnings of 45 lakhs. Then you see the closing of 75 as well as 75 lakhs and 1 crore 50 lakhs. That's simple. Again in August of 24, that is before you were acquiring control, a dividend was distributed, that is 12%. 12% of 30 lakhs comes to 3,60,000 is the dividend. Sorry, 12% of 300 lakhs comes to 36 lakhs, and you have been told that this 36 lakhs has been paid out of the balance on 1st of April 2024. So this is clearly out of the pre column. So what I do is I will allocate this 30 lakhs goes to pre, 45 lakhs goes to pre. Once I find the balancing figure, I believe this 1 crore 41. Remember, I have to allocate it between pre and post. Control is acquired on 1st of January 24, which means the first 9 months are pre, the next 3 months are post. So this is 9/12 in pre, 3/12 in post. Similarly, 9/12 in pre, 3/12 in post. This 36 lakhs is clearly out of the pre profits and you deduct it from the pre column. So this will give me the breakup as on today's date for the purpose of analysis. Now if there is any other consolidation adjustment, we'll have to do that. Now if you see the consolidation adjustment, first of that seems to be dividend. We have written a note over here that you don't need to do any separate adjustment for dividend. Well, because dividend is paid out of pre-acquisition profits, okay, so adjusting entry is usually needed, but dividend was paid in August 24, whereas control was acquired on 1st January 25. Since Z does not control in August 24, dividend is an income on investment which should have been taken. See, remember, once you acquire control, you consolidate incomes and expenses, assets and liabilities, and hence you don't again take over the dividend income because you're already consolidating the revenues, expenses, etc. But over here it is an investment, and investment income in August 24 should go to the PL. So there's no question of eliminating it, and hence no adjustment needed. in working note 1. Further, for goodwill, we need the net worth on 1st January 25. Now, this dividend was already paid before 1st January 25, that is in August 24. So, it reduces my net worth. And hence, over here, dividend is paid before that would correctly reduce the net worth, and hence no adjustment is needed. So, there is no adjusting entry. So, we are just explaining that because dividend is paid out of pre-acquisition profits 1, but it is paid before the acquisition date. Remember, I mean, dividends can be paid in the last 1, 2, 3, 4 years. I don't keep on deducting that. I will only deduct dividend if it is out of pre-acquisition profits and it is paid after the acquisition date. So that is there in most of the questions. However, in this particular question, similar to I think question 40 that we did, that is a November 23 very big question, also a similar adjustment is there. Okay, so there's no further adjustment needed for dividend. Then you look at the machinery. Now this is a little different adjustment. Like usually when we look at the machinery, what happens in case of a machinery? Yeah, so we typically have the balance on the acquisition date, but in this particular case you don't have the balance as on the acquisition date. You have the balance somehow 3 months before the acquisition date, 1st of October 2024. Now I need to find the balance on 1st of January. Now I don't know exactly the value of the machinery, I don't know exactly the book value, but I know as a matter of fact. So this is a relatively simplified adjustment. There's an alternative treatment possible over here. The institute has ignored. The simplified adjustment over here is, well, should I do the entire fair value adjustment for 15 lakhs? No sir, the 15 lakhs was the overvaluation, that is your machinery is overvalued on 1st October, based on which, I mean, in your books, let's say, I don't know, let's say the machinery on 1st October 24 was, let's say hypothetically 1 crore 15 lakhs in your books, though the true value is only 1 crore. So in your books the depreciation would have been charged at 10% on a WDV basis. It is assumed that is on the balance on 1st October 24 only. So this will be a 10% depreciation which is charged in your books based on 1 crore 15, when the true value should have ideally been 1 crore only. And as a result, there is an additional depreciation charge in your books which needs to be reversed. So what we do over here is we say that, well, you know what, there's 15 lakhs. However, 15 lakhs is your overvaluation, which means the machinery has to be decreased. But if the machinery decreases, the depreciation that must be charged should be relatively lower. You might have charged a higher depreciation. The actual depreciation is relatively lower. By how much? Well, it will be 15 lakhs into 10% into 3 by 12. So this will come to around 37,500 for 3 months. These are 3 months from 1st October to 31st March, which means I would say if I take this, there should be a net 14,62,500 reduction. Like if this 15 lakhs was on 1st January 25, then perfect. I would have directly reduced 15 lakhs from the machinery and correspondingly given effect to the pre-reserves. However, in this case, 15 lakhs is on 1st October. If it was overvalued by 15 lakhs on 1st October, that means the depreciation for the next 3 months will also be, would have been additionally charged on that 15 lakhs, and hence we need to reverse that additional depreciation as well for those 3 months, which will be around 37,500, and hence 14,62,500 will be the base on which you will do the initial fair value adjustment. Machinery will be credited by 14,62,500 and your pre-profits will be debited. So if I look at your workings, pre-retained earnings 14,62,500 to machinery. So if I look at pre-retained earnings, this is initial fair value adjustment 14,62,500, and there will be a separate adjustment within the machinery column of 14,62,500. It is overvalued, so we'll have to deduct. Now this will take care of the adjustment on 1st January. However, after 1st January as well, there are 3 months, January, February, March, over which in your books the depreciation would have been charged at 15 lakhs into 10% into 3 by 12. This would be the higher depreciation that would have also been charged in the last 3 months. So again, you are considering the values based on 1st October 24 numbers only. If you sit and accurately calculate, there might be slight differences over here, but the institute has done it in a slightly more simplified manner, and hence you can stick to that, where you can say that, well, you know what, on the depreciation is 10% on, let us say, the balance. We don't know the exact balance, so if 15 lakhs was the overvaluation, on that into 10% into 3 by 12, let us say that is 37,500 for October, November, December, into 3 by 12, another 37,500 for January, February, March is the additional amount that is charged, and hence this additional amount for January, February, March is post-acquisition period. So If I reverse the depreciation, that means my P&L will be credited and my machinery will be debited by 37,500. So for reversal of depreciation, my entry would be machinery debit 37,500 to the post P&L 37,500. So on the credits, reversal of depreciation 37,500, this was January, February, March, and in the machinery, I will add this 37,500 and that's about it. So this is another adjustment. Then you have these bills receivable and bills payable to be eliminated. We have said that the intercompany bill elimination would not include the bills which have been discounted, but other than that there are still other bills. So if I go to see, there is a bill receivable of 4 lakh and a bill payable of 7 lakhs. So what will I eliminate? I will eliminate the 4 lakhs which are still intercompany receivable. The other 3 lakhs have been discounted with the bank and hence that will still continue to appear as a payable for the group. So your intercompany elimination on the bills will be for 4 lakhs, as you can see over here, from the receivables and also from the payables. And if you consider this, then largely you are kind of taken care of. Now when you take these workings, you will just do these totals, out of which I will say the pre-amount, because the entire 100% parent and NCI share will both be taken to your working note. For Goodwill, we will take the net worth as pre-GR as well as retained earnings is the pre-retained earnings. Now when I go to the post, I'll have to break it between 85 and 15. So 85 will go in the consolidated working note number 1 and 15 will go in the NCI working. So as you can see, 168 for post GR, 153 or 53 for, let us say, the NCI, 956 and 3028 125, 956 and 3028 125, and that's about it. So you have taken all of these effects. Now after you take these effects, what you do is you try to total up the NCI. Again, within NCI we take the equity, along with that we take the preference shares. We don't take it as a part of liabilities typically. Alternatively, you could have even shown this as a part of your non-current liabilities, financial liabilities, though institute treats the preference shares similar to owners, but it does not take them into the goodwill working. Remember that institute treats preference shares similar to owners, but it does not take them into the goodwill workings, which means if they treat it similar to owners, like the parent's preference share capital will come in the share capital, the subsidiary's preference share capital, which is intercompany, would be eliminated with the gain or loss going in the consolidated P&L, and the remaining preference share capital will be shown in NCI. So this will be your total NCI. Then when you do the workings, I will say that you have taken your total net worth, and with that you get 77,62,500. This is your net capital reserve or gain on bargain purchase. Now the problem is, if I take this gain on bargain purchase in my balance sheet, which I can very safely take, well, there is also some goodwill. Now the institute has given you two alternative solutions over here. They have kind of mentioned that, well, in a way, simplistically, for R as a whole, I want to show a single goodwill or a single capital reserve. I don't want to show for R as a whole two different values. So they kind of say that fair enough, there's already a 45 lakh goodwill. If I separately show 77,62,500, well, I'm considering goodwill is a separately identified asset, and then there is capital reserve which is separate. If I don't want to do that, I can net that off, which is what institute has done. So they have taken the 77,62,500, from this subtracted the 45 lakh goodwill which is in the SFS of R, because they have said that for R as a whole there will be a single number either or as a goodwill or either as a capital reserve, though they have even given at the end of the solution that there is an alternative treatment possible where you can show the 45 lakh goodwill separately and also 77,62,500 separately, though in their main solution they have netted off. So it is preferable that we also net off. So that comes to 32,62,500 net capital reserve, and from the goodwill we subtract 45 lakhs. We don't show that separately as a separate identifiable asset. For R as a whole, a single number is shown. So other than that, you load up the general reserve, you load up the retained earnings, and then when you prepare the consolidated other equity, within that you will take general reserve, you will take retained earnings, and you will take the net capital reserve, which will come to a 379,96,875 consolidated other equity. Again, at the cost of repetition, if you see the last part of this institute suggested answer, they say above solution has been drawn considering the goodwill being residual in nature and has no fair value. However, one may draw a solution considering goodwill as an identified asset. If that is the case, then 45 will appear as goodwill along with 75, and 77, 62,500 will appear as your capital reserve. In this particular case, we are just netting these two off and showing the net 32 62,500, 75 separately for the parent is separate, but for R as a whole, we are showing a single number. So if you take all of these and then you total these numbers, you'll get the total PP, investments, you'll remove the goodwill of the subsidiary, you'll have, let us say, certain remaining investments, inventories, and you put all of these numbers and your balance sheet should hopefully tally. So I'll just share this with you on the Telegram channel as well, along with the reference notes. Just forgive my handwriting, I've just written it in a bit of haste, but hopefully you should be able to kind of understand the essence of the treatment. You don't obviously have to write these reference notes. So this is our solution, which exactly reconciles with the institute solution as well, and hopefully this kind of helps you in your overall preps. So keep studying, keep pushing your limits. You are very close and you are going to do really great. God bless you all. Take care, good luck, and see you soon.